Is a crash incoming? Can we read the tea leaves of the super investors to discern the short-term outlook? They are the best of the best. So one of the best ways to be great is to study those who are already great. Each quarter, I like to review what the investing greats are buying and selling. I view these super investors as a bellwether for the economy, and we can get some great ideas for our own portfolios as well. So today, we are looking at what they bought and sold in Q3 of 2024. Welcome to the Quality Investor. Many of the top investors share certain traits. They hold for the long term. They tend to have concentrated portfolios. And what they buy or sell may reveal their thoughts about the economy or what industries are ascendant or declining. So by studying these investors, we can become better at honing our own investment strategies. For the investors I generally follow, some interesting patterns emerged in the latest round of 13Fs. There seemed to be much more selling than buying. We can only speculate what this means. However, I believe a general belief is forming that valuations are starting to stretch and an opportunity is there to build cash piles. For what these investors want to build their cash piles for is up for debate. Do they believe a market reset is coming? Are they simply taking profits? Are they prepping for a higher tax environment? Remember, at the time these sells were being made, the US elections hadn't happened yet. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Part of the Kamala Harris tax plan included taxing unrealized gains, which is insane, but that's another discussion entirely. I'm leaning towards stretched valuations. However, that doesn't mean a reset or even crash is coming. This is something I want to expand on in a different video, but a market crash typically has some catalyst that triggers it. Crashes don't happen because valuations are simply elevated. Crashes result from hidden or ignored systemic risk and or a black swan event. 2020 was a COVID black swan event. The 2007 Great Recession was mortgage-backed security risk, or rather ignoring the risk, and terrible lending practices. The dot-com bubble burst once people realized they were investing in tech companies that had hardly any revenue or business models that were completely unsustainable. This is very high level, of course, but right now, it seems like there aren't any real catalysts for a crash. That said, the nature of crashes are no one sees it coming, and they are usually different from previous crashes. I say all this with the caveat that crashes are generally unpredictable, and regardless of what the overall market is doing, always focus on the real, grounded fundamentals of the businesses you are actually buying into. Base those decisions on the nature and future of that individual business and not the general hysteria surrounding the market or industry. Thanks for allowing my digression. But let's look at what the super investors are doing. Today, we're going to review 4 different investors. The investors are David Tepper, Daniel Loeb, Bill Ackman, and Warren Buffett. In a part 2, we'll discuss 4 other investors, but that video is coming at a later time. So let's begin with David Tepper. David Tepper is a hedge fund billionaire who runs Appaloosa Management. He's a little bit more well known as the owner of the Carolina Panthers, and frankly, he's not done a very good job running that NFL franchise, but he's done a lot better as an investor. On a 1-year basis, he's up 34%. On a 3-year basis, an impressive 16% CAGR, a 20% CAGR on a 5-year basis, and a nice 11% CAGR on a 10-year basis. So he does a pretty good job in the markets. Looking at his largest holdings, we have Baba or Alibaba Group Holdings, Pinduoduo, Amazon, Microsoft, Meta, Google, JD.com. A lot of e-commerce here. And even Meta, they have the marketplace, the Facebook marketplace platform. And besides e-commerce, he leans very heavily into tech and internet-based businesses. Oracle, Lyft, Advanced Micro Devices. But what really stands out in this quarter is look at all the reductions in his holdings here. He's reduced nearly every position that he holds. Now, it's very possible that part of these reductions was so he could make large purchases into other e-commerce platforms like Pinduoduo, JD.com. He really added a lot more to his Lyft position. But in general, it looks like he really took a lot of profit. And that really makes sense. When you look at some of his top holdings, Amazon, Microsoft, Meta, and Google, you could really argue that a lot of those companies are starting to get into that stretched valuation territory. Now, Google, however, they're facing another issue entirely. And that's a whole nother video discussion. If you hadn't heard, the DOJ issued their proposal to remedy Google's search monopoly. And that remedy is essentially sell off Chrome. That's a whole nother can of worms there. And obviously he reduced his position here before that even happened. But by and large, it looks like he's taking a lot of profit and building a cash pile. Since he pretty much sold off every single one of his businesses, you can't really know that he's favoring or disfavoring one industry or one business over the other. One thing I did notice, though, is he did also open positions into Las Vegas Sands and Wynn Resorts, as well as Vistra Corp and NRG Energy. So he sees something in Vistra and NRG in the utility sector, and he's seeing some bullish signs here in resorts, which could be a good thing for the consumer. Overall, though, I do like his portfolio. Personally, I tend to avoid foreign companies because I just don't know much about them, but very tech heavy, and a lot of stocks that I also own, which makes me feel good, but also businesses that are just sound fundamentally, that are all necessary to their ecosystem or the industry they operate in. Next, we have Daniel Loeb of Third Point. Daniel Loeb also has a portfolio I really like. His performance on a one-year basis is nice at 35%, although his three-year performance is pretty much flat, negative 4.35% overall. And on a 5 and 10-year basis, he's returned a CAGR of about 10%. But we also notice here the same thing that we noticed with David Tepper. A lot of selling. However, the difference here is it looks like he sold in order to buy other things. It doesn't look like it's a profit-taking or cash-building type of maneuver here. He doubled his position to Intercontinental Exchange. Intercontinental Exchange, of course, operates financial exchanges. Notably, they own the New York Stock Exchange, but a very wide mode business in that there's not a lot of competitors out there in financial exchanges. But he also bought a lot of new positions. Brookfield Corp, which is going to come up again, Flutter Entertainment, LPL Financial, Carpenter Technology, Tesla, a brand new $100 million position, and probably one of the best growth stocks out there, who currently has a lot of bullish sentiment behind them now, considering Elon Musk is Donald Trump's right-hand man. And also one I found quite curious, CVS Health. I found this interesting because CVS's main competitor is Walgreens. And Walgreens is on a downward spiral right now, closing pharmacies. Their share price has fallen a lot over the last year, 3 years really. And CVS is in the same business. And pharmacy retail seems to be a dying business. However, CVS really transforming their operations into a health provider company along the lines of United Healthcare. So it looks like what Daniel Loeb is doing is more or less trimming some positions in order to add some new positions to his portfolio. You notice he didn't sell out of anything completely. He just reduced positions that you can see have run up quite a bit. Next, we have one of the more interesting investors, in my view, Bill Ackman, Pershing Square Capital Management. Bill Ackman has achieved a bit of a semi-celebrity status given his very outspoken views around the election and some of the very public battles he's had with other investors such as Carl Icahn. He certainly does not shy away from the spotlight. His one-year performance is about 20%. On a 3-year basis, it's pretty much flat. And on a 5 and 10-year basis, he's about a 10 and 9% respectively. Now, I said that Brookfield Corp would come up again. And Bill Ackman started buying that last quarter, Q2 of 2024, a little over 6 million shares. And then he nearly quintupled his position up to 32.7 million shares in this past quarter. He now owns almost 8% of the entire corporation. Brookfield focuses mainly on investment management in the real estate sector. And what's really interesting to me is they have not been performing poorly. They're up nearly 64% on a one-year basis. Typically, Bill Ackman likes to buy into businesses that are sort of in a lull or in a downswing, which we'll get to in a second, because he's an activist investor. So I'm very curious to see what his plans are going forward for Brookfield. Having a nearly 8% stake will make him very persuasive when it comes to the board of directors. He also more than quintupled his position in Nike. Now, Nike has over 1.5 billion shares outstanding, so 16.2 million shares isn't going to be a large percentage of the business. So it looks like he's starting to build a position to allow him to get influence there. Nike, they are an underperforming business. They have a world-renowned brand, but they've been plagued with issues with theft and allowing other premium athletic apparel retailers catch up. Brands like Lululemon and Hoka. So Nike is very much a turnaround play. And I think Bill Ackman, who's known for buying into distressed businesses and then being instrumental in altering the direction of management, I think he's going to be pushing for some changes over the next few months and quarters as he builds that position in Nike. But other than that, not too much change in his very concentrated portfolio. And last, but certainly not least, we have the legend himself, Warren Buffett. Warren Buffett needs no introduction, but right away we notice most of his activity is selling. He trimmed his Apple position yet again, trimmed his Bank of America by over 20%, and he's also selling down in Capital One and New Holdings. Essentially, he's selling some of his bank positions. He's been very critical of banks and how they report their marketable securities. I'm not going to get into that because I just don't know much about banking, but there's something there he doesn't like to see. Now, he's also obviously building a cash position. He clearly believes that valuations are stretched right now. He's made no secret about that, and he has a cash position of over $320 billion. And there's a lot of speculation as to why he's building such a large cash position. Some speculation around he believes a crash is coming and he wants to be the buyer of last resort, because who has $300 billion of cash? Absolutely nobody except for Berkshire Hathaway. Or possibly he just doesn't see any good opportunities out there. And I kind of see that. He's famously conservative when it comes to his investing. And if we're being honest, the valuations are very stretched out there right now. And there really isn't a lot of good buying opportunities, especially for the type of business that Warren Buffett likes to own. Businesses that are incredibly boring and predictable. But Warren Buffett doesn't make moves until he believes there's absolutely value there on the table for him to grab. Another reason he's cited his selling of Apple was for tax reasons. He's been very critical of the amount of debt the U.S. has and the amount of spending the government does, and he believes that something will have to give in the future, and that something is going to be taxes going up. So he stated the last Berkshire annual meeting he sold Apple because he believes there's going to be a less favorable tax environment in the future. Other than that, that wraps up part one of my look at what the super investors did in Q3 of 2024. To me, there's a lot of selling, not a lot of buying, and it looks like it's due to stretched valuations and these investors taking profits. The selling was all over the place, so you can't really pin down one industry over another being favored or disfavored. And I tend to agree. I don't really see a lot out there right now that's a really good buy. So I myself am holding on to the cash I have coming in, and I'm going to wait until I see a very good opportunity. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.